Hello, my name is Carlos McWhorter, CPA, and we have another stock analysis of the behemoth of a company, Microsoft, one of the best companies that you can invest in my opinion. So we're going to take a look at the revenues, the cash flows. We're going to take a look at how this company is creating economic value compared to the rest of the industry, look at the balance sheet and give my assessment on the valuation of the company to see, is this a company that we want to consider investing? And I think you already know the answer to that. So let's go into Microsoft, looking at the all-time chart. Now, Microsoft is one of my favorite investing lessons, and here's why. During this time when I started getting into investing a few years after college, around 2010, around 2012 timeframe, I remember hearing Microsoft was dead. I remember the articles. Go ahead and Google it. It's hilarious when you go back and read it. CNBC has articles. All of the experts were telling you around this time frame, Microsoft was dead. Now, granted, right now we know like what an opportunity people had to invest in Microsoft during this 15-year period where the stock was pretty much flat. Now, during this time, Microsoft was growing their revenues at about 8% per year annually. So every year they're getting better and better and better and better as a business. And that stock pretty much stayed flat for that whole time period during the lost decade. Some of you understand that term, from the tech crash all the way to 2010. And even beyond 2010, Microsoft struggled. Now, here's a lesson. We know what Microsoft is today, but during this time, Microsoft did not innovate much. They came out with the Microsoft Zoom that was going to rival the iPod, which was a great product, but the iPod won because the Zoom didn't really compete with the integration that Apple had. Also, if you remember the Microsoft phone, the Windows phone, that launched and pretty much was a flop. It didn't really do much. Then Microsoft launched Bing, and they still have it, but it was clear that Bing was not going to overtake Google as Microsoft had hoped. So the experts were saying Microsoft is dead. It's over for them. And as we see now, of course, hindsight is 2020. We see now it is not dead. But here's the lesson. Hindsight is 2020, excuse me. Hindsight is always 2020. That's what people say. But how can we have the 2020 vision during the time and not wait until hindsight? Microsoft was still a cash cow. It was still creating cash flow, still consistent because of their core business. During this time where they were dead, everybody was still using Microsoft Word, Excel. Everybody was going to work and using Outlook. They were still making money. Their core business was still dominant, still successful, still growing. So they had plenty of cash and plenty of runway to experiment and even fail. They can afford it. That's one of those companies where if they're innovating, great. If they're not really a hit and stride with some of their innovations, could be a sign for a troubled future. But for the most part, that was just not the case with Microsoft, because they continued to, their core business continued to steamroll their industry. And as you see now, it's clear as day that even though they had those failures, that they're still a great business. So this is one of the great lessons in investing. Don't be so quick to jump ship, even in a 15-year period when a stock is not really moving. This is why we have to be patient, because the people who held through this time, receiving dividends through this time, they're happy that they held. Of course, you know how it is. People start jumping in this time frame when the stock starts to go up again, but they miss out on so much gain by not being patient. And we want to make sure we're being patient all the time. So as we see all-time chart, of course, everybody who has Microsoft, they're sitting high at $416 per share. Right now, the PE is trading at about 35 times earnings. So earnings per share about $11.79. So beta 0.9, so a little bit less sensitivity to the market. That makes sense for the type of company they are. Market cap over $3 trillion. So very large company, very successful business. So let's look into the details, do the fundamental analysis, and go from there. So starting off with the business segments, we see that 41% of their revenues comes from their server products and cloud services. We have 23% from office products and cloud services, 7% from LinkedIn, 9% from gaming, 10% from Windows subscriptions. So that pretty much makes up where they get their business from. Or get their revenues from. So let's look at their revenue trends over the past 10 years and see how they measure up. So over the past 5 years, we got a 14.3% growth. Over the past 10 years, 12.2. So it's solid growth for a mature company. And we see that growth over the past 5 years is accelerating. 2016 has some negative growth here, negative 0.2, very minor, but as you see, they're bouncing back. So pretty solid growth, but we do want to note this company here, this is the trailing 12 months. So their fiscal year ends at June. So this is pretty much obsolete. It's the same number as before. So we're stopping at 2024, June 30th, 24, $245 billion in revenue, 15.7% growth over the past year. So a solid company able to churn out 14 or double-digit growth consistently is a great sign of a mature business. Many mature businesses that are still great are not even able to get to that double-digit mark. So this is amazing. Great revenue growth for Microsoft. So looking at free cash flow. Free cash flow over the past 5 years, 11.2% growth. 3 years, 8% growth. So 2015, they were at $23.1 billion. Now they're at $74 billion in free cash flow annually. Major growth of 24% over the past year. So pretty solid. Again, we still have lots of double-digit growth, which is great to see for a very mature business. This means this business is continuing to grow their revenues and continue to grow efficiencies. So we love this. Balance sheet, let's take a look. Amazing balance sheet, very strong. So as you see, this company, Microsoft, is able to pay off their debt on a 5-year average. We're able to pay off their debt in less than a year. They have cash flow, $74 billion this year, compared to $42 billion in long-term debt. That's a 0.6. The worst that they've been over the past 10 years is this period where they're at 2.4 years. Still below our golden threshold of 3 years. 3 to 5 is golden. So 2.4, they haven't even hit that 3-year mark. Balance sheet is amazing. It's what you want to see in a very mature business like Microsoft. Can't complain there. Dividend. Right now they're paying a dividend at a 0.7% dividend yield, paying 75 cents per share. So that's not very high. 0.7% dividend yield. Now, again, the yield is comparing to the current price. So maybe if the price is overvalued right now, that yield can look a little weaker just because of the stock price. However, for this company, 29.4% payout ratio. So 29.4% of their cash flows is paid out in dividends. That means as a company, as we've seen, as they're growing their cash flow, as they are, and they're only at 29.4% this year, that means as that cash flow grows, this payout ratio could even drop lower, which means Microsoft has lots of room to continue to pay out dividends and also continue to innovate and reinvest into the business. So this is a great position for them to be in right here. They've been growing their dividend over the past 5 years at an average of 12.61% per year. This is why I say dividends are the new pension. How many people get an annual raise of 12.6%? Maybe a promotion, maybe if you take a new position in a new company, you might be able to hit that. But annually, who gets a 12% raise in this economy, in this world? This is why investing as much as you can, that way you can have significant dividend income that's raising at this rate when you invest in these types of companies is golden for retirement. And even early retirement, if you want to do that, create that dividend income. Microsoft is a company that has been consistent in giving people that. Shares outstanding. We like companies to buy back shares with their excess cash flows, increasing the value to the shareholder. As I like to say, I love a company that continues to throw people out the party. More room, more drinks, more food for me. So as you see, consistently, they continue to buy back their shares. A little major decreases this year, in the past years. This year, not so much, down a little bit. But as you see, that trend is coming down pretty sharply. Great sign for Microsoft. Great position for them to be in as far as buying back shares. Now, the only negative is this stock could be overvalued. So they could be overpaying for these shares here. That's the only thing that could be a little bit alarming. And maybe this is why they decreased the rate of share buybacks this year, because I think the stock is overvalued. So this makes sense. You want to continue to make good on your promise of buying back shares when you make those share buyback announcements. They've had announcements every year, $60 billion over the next 5 years or whatever it is. They keep making the announcement. So yes, buy back some shares, make good on your announcement, make good on your promise. However, as a shareholder, I don't mind if you delay it some years, just because right now the stock is a little bit high. So I think this is a good thing that they did, kind of slowing down the rate of buybacks because of the stock being so high. So I'm liking what management is doing here. So let's look at the economic value added. Are you earning enough money on your capital that covers your cost of capital? So your interest rate and the opportunity cost for the capital that's coming in. The cost of capital for Microsoft right now, 6.7%. That's 3% below the industry average. They're earning return on capital employed, the return that they're getting on the capital that they acquired to run the business, 28%. That's 5% higher than the industry average. So Microsoft is killing their competitors with adding 22% value annually. This is the average over the past 5 years. So the past 5 years, the industry has done 13.28%. Microsoft has created more value of 22%. This is a great plus for Microsoft. So check that. That's great. I love to see a company who is dominating their competition. You always want to look at metrics like this and compare it to the industry. Don't tell me a company is great. I want to see it in the numbers. I can see that Microsoft's management is allocating capital and figuring out how to serve their customers and earn a great return on their capital at such a higher rate than their industry, their competitors, I should say. So let's look at the last thing. The last thing I like to look at, okay, let's look at their valuation and get an idea of where they are compared to what I think their value is. So looking at the 5-year average of free cash flows of 60 billion, that growing, it's projected to grow at a little bit over 14% over the next 5 years. Weighted discount rate, I use a weighted average cost of capital of about 6.8%. With such a quality business, my terminal value, 25 times free cash flow. These are my estimates. So look, right now they're at $416 per share. My estimate says the stock is worth $288 per share, downside of about 30%. So as an investor, if I'm investing a large lump sum of money, I would be wary at this valuation because of that potential downside. If you a dollar cost averager, none of this matters. Continue to invest in this great quality business that as we just seen, and don't worry about the valuation. It's not going to matter in the long run if you stay consistent with the investing. So you might be, let's see, this is the stock price. Let's say this is the stock price now, and this is the value of the company. Even if you're buying at these higher prices, eventually, as the stock continues, the value will drop down, continue to buy at these prices. This will be your average. The average will be, your average cost is going to be the actual true value of the business over the long run. So dollar cost averagers, they typically don't lose when they invest in companies like Microsoft because the timing does not matter. If you're someone who likes to look at valuation and the timing matters, I'd say be careful around this range, in my opinion, just because of the potential downside of the business. 14% growth, great quality. Sometimes you have to be willing to pay a premium for a quality business, but do I want to pay this much of a premium? I don't know. So let's look at the summary of what we reviewed today. So again, everything looks amazing except for the valuation of the business. For those looking to put a lot of capital away at one time into this business, this may not be the right time just because of the valuation. Other than that, Microsoft is one of the most quality businesses ever. So that is my review of Microsoft. I hope you enjoyed it. Let me know what you think in the comments, and I hope to see you in the next video.